Hi, I'm Jessica Irving Marshall, and today we're going to go over some of the provisions of the OBBBA tax bill that were codified in July of 2025, but they are going live in 2026 and are important to have on the radar. So the OBBBA was made law in July 2025, and some of these provisions start taking effect in 2026. So this is an overview of what those provisions are. And also I have to mention what spurred me doing this article is from this gentleman who writes for Accounting Today, which along with the Journal of Accountancy is something I get very excited for when it comes in the mail, which I guess you'd have to be a CPA like me to understand how exciting this is. So this gentleman here, Mark A. Loosecombe, I hope I'm saying his name correctly, but every column that he writes is like he's speaking directly to my client base. So I'm very grateful for his writing and for that fantastic periodical. And I still do enjoy reading magazines in paper. Okay, so why this is a pivotal year. Like I said, the tax law was enacted in July 2024, but the second wave is now in force. So some of the things that they said before, try your best, is more of, okay, you need to do this now. 2025 rules now operate differently. Some of the provisions that touch 2025 are now in full effect, which is what the prior point was as well. The transition relief has expired and planning beats the reaction, because if your team and your company is not following these things now, it's going to be a nightmare once you're in January, February of next year trying to amend filings and do things the right way. So individual provisions, I'll go through these first. So these are provisions for individuals as well as some pass-through entities that report on the individual 1040 tax return. Big change, charitable contributions. There were 3 structural changes. So now someone who does not itemize deductions, remember itemized deductions are the Schedule A, and you need to exceed the standard deduction to be able to take the itemized deduction. With the TCJA, which is the prior tax code of December 2017, it's now estimated that around 90% of people do not itemize. But now people who do not itemize, there's a $1,000 deduction for charitable giving, cash, not non-cash, so your goodwill does not count. Cash deduction, $2,000 if there's 2 taxpayers if you're married. Remember, the Schedule A has medical and dental expenses on the top, which hardly ever come into play because of the 7.5% AGI limit. So usually those come in when there's something catastrophic, and it's not a good thing. We have the state and local tax, which I'm going to get to. That cap has been lifted to $40K only if your MAGI is underneath 505,000. I'll get to that slide so I'll know it for sure. Mortgage interest, and remember that the mortgage interest can be capped on $750,000 of outstanding principal if it was taken out 2018 or later, $1 million prior to 2018. There's a new itemizer floor. This will come into play especially for some of our higher earning clients who regularly itemize. So contributions are deductible only above the 0.5% of the contribution base. So if you have 200 grand of AGI, the first $1,000 of gifts, of gifts generally produce no current year deduction. There's special carry forwards as well. My other company, the Green Mission Inc., has a specific article and video that we're going to be putting out just for that, because that's what that other company does, is non-cash charitable contributions, appraisals. QCDs bypass the floor. So remember, in your planning, these QCDs are when you take your IRA, your investment funds that would otherwise come out taxable. Think about if you have RMDs, if you're 70 and a half or older, you can donate those distributions to charity and you do not pay the taxes on them. And that floor of the $1,000 on, say your AGI was 200,000, that 0.5% of AGI floor doesn't exist. So it continues to be a great vehicle. Check in with your financial advisor. I always say to make sure you have a really good financial advisor that works with your tax team, because we work in our own lanes but in concert with each other, and we really have to rely upon the other person doing their work for us to be able to guide on tax policy. So the overall itemized deduction limitation, some of you may remember the PEAS amendment, PEASE, that was the prior law where the Schedule A would start to phase out over a certain amount of income. So that's gone. We don't have the PEAS amendment, but we do have maximum federal benefit per dollar of affected itemized deduction for taxpayers in the 37% bracket. So remember that we're in a bracketed ordinary income, the 0, 10, 12 on up. 37 is the highest tax bracket. So if your income is in there, which begins at $640,600 for single, $768,700 joint. There's deductions are reduced by 2/37 of the lesser of total itemized deductions or taxable income above the 37% threshold. We do those calculations, and I sure hope that the IRS and Thomson Reuters, who creates our tax software, hopefully they will have that live and ready to calculate come tax season. Top bracket taxpayers should model the combined effect before committing to major gifts or discretionary deductible expenses. So permanent rates, the standard deduction, and seniors. So what is permanent? The OBBBA codified the tax rates that I just went up, the 0, 10 going up to 37%. They're no longer sunsetting, which is what used to be in the law. Standard deduction is jacked up permanently. So we will have a continuation of the majority of taxpayers not itemizing, which is great for them, and it's great for CPAs because most CPAs do not want to be doing a lot of 1040 returns that could otherwise be done without a CPA or using online software. So that's great. They're simpler in that respect. But the senior bonus deduction of $6,000, this one makes me a bit angry. So this was billed as a bonus deduction for seniors. First of all, there were a lot of people who came to our practice this year or were asking questions all throughout the year. Hey, well, I heard Social Security benefits are no longer taxable. That's part of the law. It's not part of the law. That would require a major act of Congress. Social Security benefits are taxable. They always have been. If you're living off of just those benefits, then you're going to pay 0%. They go all the way up to 85%. The majority of our clients who receive SSA, it's maxed out at 85% because they have additional income, whether it's other retirement plans or they're still working and they're doing consulting or regular W-2 employment while they get SSA, because in this economy, not a lot of people are able to retire that we see in our practice, or they just love working. So there is a senior bonus deduction, but $6,000 per senior, that's great if it really applied to most seniors. In our practice, I don't know how many seniors we would have, but of the ones that we did have, we had only 2. We have about 430 clients, 2 who could actually take this, because it phases out for single taxpayers over 75 grand and over 150 for joint. So if you have 2 people that have Social Security and a few other investments, they very easily blow right past that 150,000 and it phases out. So the majority of them got nothing, number one. Number two, Social Security is taxable. So that was not true when that was communicated that was not taxable. It is not taxable for states. It never has been. That's always been part of the federal law. But this $6,000 that they give expires after 2028. And we're going to drill down into some of the other provisions that expire after 2028, which is quite telling, because those are the provisions where we can have QSBS and opportunity zones, and this 37% is the highest effective individual, 21% corporate tax, QBI is forever. Those provisions are forever. The other provisions, no tax on tips or overtime, the senior bonus, they expire in 2028, which is right after the midterm election. So there, read into that what you will. What gets me fired up is that when there's the false advertising on what is in the tax bill, we all need to know what's in there and what is not in there. State and local tax deduction, this is called the SALT cap. This was lifted to $40,000 in 2025. It's up to $40,400 for 2026. But keep in mind, You can't have MAGI, which is modified adjusted gross income, above 505,000 for combined filers. So you need to, where this makes the most sense would be 2-income household in San Francisco that has adjusted gross income of about 450,000. They're paying tons of state taxes. They can just max out, and the mortgage interest, they very easily have 750,000 mortgaged, if not much more, because of the housing prices there. Think New York City as well. So it's someone who, in those areas, when you have two people making 400,000, they very easily could be struggling, especially because the cost of living is so high in those areas. Those are the people that we saw Schedule A's plumping up to 72,000. If you are one of those people, make sure that you understand the charitable contributions, look at bunching, really maximizing the heck out of that Schedule A for the year. Good tax planning opportunity there. PTET elections remain available. So those are the pass-through entity tax elections at the entity level. So those are still there. They really help our taxpayers who are in higher tax states. Estate and gift tax exclusion is $15 million per person, so $30 million for a married couple. Remember, the annual gift tax exclusion is $19,000 per recipient. So definitely check in with your attorney, your estate attorney. If you don't have one, I have a great recommendation for someone I really trust. Make sure that you are meeting with them prior to it becoming an emergency. Make sure that there's liquidity, and make sure the estate, if it's going to survive, that there is enough money for taxes and admin. Rebalance gifting, consider that lifetime gifting, filing the 709 gift tax against that lifetime exclusion. Otherwise, you have what we have a lot of our clients doing. An example, Northern Virginia. We have many clients who bought their first home in Arlington, Vienna, Falls Church for maybe $35,000, $50,000 back in the 70s. They now are in their 80s and 90s, and the homes are worth close to $2 million, $2.5 million. So they could sell, and they could potentially exclude the $500K, but then pay a boatload of taxes, as well as the additional taxes that are triggered with the passive sale and IIT. Or they can pass away in the home, and then their heirs get it for basis, and they can sell it the next day or minutes after receiving it and not pay any capital gains. That's kind of the conundrum that we're in some of these areas like Northern Virginia, where the housing supply is so strict. And there's a good reason that people are staying in and dying in their homes. So consider gifting. You have that $15 million per person exclusion, so make sure that that's part of the conversation. Trump accounts, $5,000 a year, operational when the OBBBA took effect. Form 4547, kids who were born 2025 through 2028 qualify for the one-time $1,000 federal contribution. Employer contributions are limited to $2,500, not taxable to the employee. So coordinate with your, again, financial advisors are for everything. Make sure that you're coordinating with them and look at those plans, look at maxing these out. The 529 K-12 limit doubled, so the annual limit for elementary and secondary expenses rose from $10K after 12/31/25 up to $20K. The remittance excise tax. So this does not apply to a lot of our clients, but when it does, you need to know about this. The new excise tax applies to certain remittance transfers made after 12/31/25. So they come to play this year, reaching cash and similar physical instruments sent abroad. So the providers bear collection responsibilities. Senders should understand which channels trigger the tax. Additional changes 2026 for all of you professional gamblers out there. Gambling losses are limited to 90%. We'll update that when that is passed through onto your income. New itemized education deduction. This one kind of gets me annoyed as well, because a lot of my educator clients are not itemizing deductions because they have not they're not able to buy houses that have tons of mortgage interest, and the state tax, because the wages are relatively lower, their state taxes are lower. So if they do happen to itemize, which can usually happen when there's a two-spouse household and the other spouse makes more money, there is now an additional expense category for an educator, which given all of my teacher colleagues and friends, this is about the least we can do for teachers with how much of their personal time and resources they put into their classrooms. Dependent care enhancements, so the employer provided assistance exclusion rose from $5,000 to $7,500. So keep in mind that the credit rose from 35 to 50%. They're mutually exclusive, meaning that the same dollar cannot support the credit as supports that tax-free amount that you receive from your employer. Also keep in mind, it's not a fun experience for clients when they have that W-2 box that's filled with the $5,000 in reimbursement, and then their child care provider is not someone with an ITIN or a company with an EIN. The IRS requires that for you to have that non-taxable. So if you are, heaven forbid, paying someone with cash and they're not paying taxes on it or reporting it, that's not going to be deductible, and you will be taxed on that dependent care. HSA eligibility expanded. This one kind of makes me kind of laugh in a not good laugh, but marketplace bronze and catastrophic plans. The catastrophic has me always scratching my head. They now qualify as HDHPs. Direct primary care arrangements no longer forfeit eligibility, and the telehealth safe harbor is permanent. And if you ever need guidance on health insurance, Medicare Part B, I have a brilliant friend who specializes just in the Medicare Part B. She's a colleague as well, and I do have some referrals for people who do understand the healthcare options. I look at all of the tax implications on the plans and to the taxpayer. And I'm glad that I don't need to know all of those rules and limits. Education credits require a social security number. So the AOTC credit, the American Opportunity, and the Lifetime Learning credits are unavailable if a student only has an ITIN. You need to look at other funding strategies. So now they require a social security number to get those credits. Closing window temporary deductions through 2028. Qualified tips up to $25,000, qualified overtime, $25,000 joint, $12,500 single, senior deduction, as I already covered, $6,000 per person. And the last provision, which is also laughable in a not funny way, I did not have one client who was able to take the U.S. assembled vehicle loan interest because, number one, it is income tied. So you cannot have a high income, but then you also needed to buy a brand new vehicle that was built in the U.S. And if you look at car prices, basic vehicles are sometimes $50,000 or $60,000 new. So there were very few taxpayers who did not make enough money that they could take this interest deduction and bought a brand new car that cost $85,000. The numbers were ridiculous to me. So just make sure that you understand who that actually applied to. It applied to 0 of our clients. And keep in mind that these 4 provisions, which are a lot of the talking points in the tax code, you do now know how you can procure those credits, number one. Number two, they expire after 2028. So keep in mind that we have a closing period here where if you do qualify for these, make sure you know about them. But from practice, like I said, it seems to be minimal. A lot of the people and just keep in mind as well, the tips and the overtime are still taxable for payroll taxes and state tax. So we did not see a huge magnitude of savings in our practice from this. Different practices might have, but that was not our experience. What was our experience is that we had many clients who took the residential clean energy incentives. They're over. OBBBA accelerated the sunset of many of these. So there's no longer the residential clean energy credit. There's no longer the energy efficient home improvement credit. And the new and used clean vehicle credits are gone. So business and corporate provisions. So moving to pass-through entities, C Corps, S Corps, single member LLCs, Schedule C filers. This is for you. Tip and overtime reporting, the grace period is over. So you need to coordinate with your payroll provider and make sure that you have the code TT for qualified overtime, TA for qualifying employer contributions to Trump accounts. Remember that overtime is only for FLSA, overtime only, voluntary tips only. And here's how that works in practice. And I've shared this with so many servers that they are so glad that the crazy CPA stopped talking to them. But if you have a table of 6 people, let's say, and there's a mandatory tip of 18% on parties that are greater than 5, if that's already calculated, those tips are taxable. It's not voluntary. It's a stupid wrinkle. So what do you do about that? I have my own idea, but I don't think it's something that I'd ever really recommend. But I have told the wait staff that if they can pull the bill payer aside and say, you know what, per policy, we need to charge you 18% tip, but you seem like a very nice person. And because of that, we would like to make sure that we're not going to put the tip in there and that you need to pay us for our tip. If they do that, that's great. You saved yourself potentially, whatever your effective tax rate is, 15-20%, if you can get them to do that. Systems must capture all year. So if you are point of sale, payroll, timekeeping, these can't be reconstructed at year end. So make sure that you're doing this in real time, contemporaneously. Work with your point of sale, Square, whomever you use, Shopify. Make sure that they are capturing the tips there. Watch for state conformity. So more than 20 states have introduced legislation adopting or decoupling from the federal. So always stay up to date on that. Look at the occupation codes identified in IRS guidance. 1-year employer reporting relief for 2025 has ended. Like I said, this is mandatory now. Okay, expensing bonus depreciation and the QBI deduction. Just like the vehicle loan interest and the tips and the overtime and the senior deduction that's only for select seniors go away in 2028, these are permanent. Section 179, 2.56 million, 2026 expensing limit, phasing out above 4.09 million placed in service, both indexed, which means that we're going to see new limits each year, and the SUV cap is 32K. Bonus depreciation, 100% permanent. At least once or twice a week, I have a client asking me, hey, towards year end, I'm looking at procuring X and X assets. Should I do that for tax planning purposes? The answer always is, do you need the asset? If you do need the asset, then you potentially buy it at year end. If you don't need the asset, the money's probably worth more in your pocket just paying the taxes on it. 20% permanent QBI deduction. Remember that the phase in to the phase out ranges, married $403,000 to $553,000. If you are an SSTB, specified service trade or business, that's what I am. That's what an accountant, a doctor, an attorney, engineer, they're precluded from the alternate method. But if you have a business that is not an SSTB, then you have an alternate method of QBI calculation that uses assets and W-2. Again, we can walk through that. It's kind of complex, but there is an option there if you phase out and make too much. S corporation owners, revisit reasonable compensation with that alternate QBI deduction if it applies, because you could potentially pay yourself more and have a higher W-2 base. Also, like I keep saying with your financial advisor, if you meet with your financial advisor and you do a full-blown 401k, then there is probably a good argument to pay yourself above the reasonable compensation if the benefits outweigh the extra taxes. So keep that in mind as well. Research costs interest in production property. So section 174A, which is the research and development. I have a separate video on this and separate articles because it's there's so much there. But essentially you can now expense, and it went with your research and development costs. It went back to December 31st, 2024. Keep in mind, you have to procure the R&D from US-based sources. This does not mean that you can't have researchers in Pakistan or researchers in Australia that are doing R&D. You just need to plop it on the balance sheet, amortize it over 15 years. Section 163J is back to EBITDA. So this is the business interest limitation. It's permanently computed on EBITDA rather than EBIT. And the difference between those are the D and the A, depreciation, amortization. So it enlarges the interest deduction for many leveraged businesses. This really comes into play and is very favorable for some of our clients that are highly leveraged. Section 168N, qualified production property, elective 100% expensing for certain non-residential real property used in qualified production activities, subject to statutory construction and placed in service windows. Manufacturers weighing domestic facilities should evaluate these closely. Employer credits and corporate deduction changes. So child care credit expanded to $500K for the employer. Corporate charity floor. So if you file the 1120 C Corp, contributions are deductible only above 1% of taxable income. Keep in mind that the limits have not changed, which are different for individuals. It is the 10% ceiling of net income. There are add-backs, dividend received, deduction. Again, if you look at our other companies, Probity and the Green Mission Inc., we have a lot more about charitable cash and non-cash donations. Meal rule changes in 2026. So you like buying employees that gigantic Costco bear that's full of animal crackers or something like that. Keep buying them, just don't deduct them, because those meals are no longer deductible. So they really firmed that up quite a bit. So that, I'm not thrilled about that, because I do like to buy our staff food, and it was nice to deduct it, but now that has changed. So they really firmed that up. They did not bring entertainment expenses back on the table either. So no country club memberships, none of those entertainment expenses, no box seats. If you take a client to a box seat though, and you purchase a hot dog for them, you can carve out the value of the hot dog, and that is deductible, because that is actually a meal with the client, but not the tickets. GILTI becomes NCTI, FDII becomes FDDEI. If you know what those acronyms mean, I will do a separate presentation just for you, because if those are ringing bells, then we need about potentially 2 hours to discuss what this means and how this is integrated into existing companies. There's a lot here. I'm going to include the slide, and then I have an overview in the article, but that deserves its own presentation. This is super important for everyone. So these are the informational returns, those 1099s. They get audited all the time, because there's always a taxpayer that doesn't get that one 1099 INT from a bank. They forget to report $10 of interest, or their entire fiduciary statement was gobbled by their dog. They couldn't find it online. Whatever happens, these are mandatory reported forms to the IRS, most of those 1099 INTs, DIB. Let's talk about the 1099K. Those are where places like PayPal aggregate transactions and send the 1099K, notifying the IRS that they have a potential taxable sale vendor. That has been changed. So it's no longer $600. It's $20,000 and 200 transactions. So that really helps people who happen to use PayPal for their business, and also they were at a farmer's market in Manhattan and they bought some jelly, and now they're looking like that's an expense, and it all gets aggregated when you're using the one account. So this is nice for that, but still keep your business records, because with or without the 1099K, if you earn taxable income, it needs to be reported. This other one along the same vein, so 1099, NEC, and MISC. The majority of these have moved to NEC, which is the contractor payments. These, before you pay anyone, if you're a business owner, unless you have proof that they're an S Corp or a C Corp, you get the W-9 before you pay them $1. Because inevitably what happens is you pay a contractor $200. You think, I don't need to worry about a W-9. I'm not going to be paying them $600. In years past, all of a sudden I look at the reconciled QuickBooks, and I'll say, oh, you paid this gentleman $800. Well, I don't have a W-9. And then you send a request to them in January 5th. It's due January 31st. The person doesn't respond. You get a bounce back. It's on the business for not filing that. So it becomes very problematic. This lifted to $2,000, which is very helpful for compliance and for the expense of filing. It's not that expensive to file. It's more of just one more thing for small businesses to do. It is up to $2,000, but like I said, if you're receiving Contractor income, it needs to go on your tax return, whether you have a 1099 or not. This is not a tax-free. If you make under $2,000, you don't have to pay taxes. You do have to pay taxes on every dollar you are selling a product or selling your services. Publicly traded partnerships, qualifying income now includes new energy and natural resource categories. Look at that. Residential construction contracts. There's a broader home construction definition. This lets more builders escape the percentage of completion method, which can drive them and their bookkeepers and sometimes the CPA insane. Clean energy deadlines. Remember, Section 179D expires for construction, and they made the expiration June 30th. So in the middle of the year. Refueling credit ended the same June 30th, and advanced manufacturing credit rose to 35%. So pending projects face very hard construction and place in service dates. You need to have this drilled down. Go ahead and drill down to it now so that when you go to report next year, it's already delineated. Benefits, employment, and healthcare. So the Benefit Plan Administration amends plans for the 7,500 dependent care limit. All of those things that I talked before about on the employer side are very important as well. So higher earners under Secure 2.0 with Roth catch-up treatment. This has all changed. So make sure you're working with your financial advisor and your CPA to make sure that you are reporting these correctly. Immigration fees and worksite enforcement. There are new mandatory non-waivable fees raised per case costs. Make sure that I-9 is complete. Re-verification, retention, and internal response protocols are standardized and audit ready. Health coverage changes. The enhanced Medicaid expansion match ended, with work requirements and more frequent redeterminations coming. ACA repayment caps were removed and premium credits narrowed, and the income-based special enrollment period lost credit eligibility. We're going to see, personally, our health insurance for our employees went up 19% year over year. Healthcare expenses are increasing, and for individuals, there's going to be people who are losing Medicaid, losing premium tax credit. I'll just leave that there. Downstream effects. New federal loan limits, again, begin on July 1st, 2026. Now capped at professional students subject to $50,000 annual borrowing limit and a $200K aggregate. There's a separate $257,500 lifetime federal borrowing cap. The AMA, which when I read the article and the research on this, child number 2 just started med school. It costs more than $200,000. So what it requires is a co-signatory and or private loans. So if you can't get a co-signatory or procure a private loan, even at, 13-14%, I guess you won't go to med school, which is a shame because we are in desperate need of more doctors. Also look at determining who they consider to be a professional. Last time I checked, CPAs are not considered professionals. Nurses were not either. I saw some nurses that petitioned Congress. I think that might have been changed. Hopefully CPAs are as well, because most of us are dying or retiring, and we need more CPAs to come into the industry, what I call a profession, and annual costs are a lot more than $50,000 a year for some schools, especially if they're private. So planning priorities for the remainder of 2026. Individuals, retest itemized, remember SALT deduction, charitable contribution, potentially bunch gifts, work with your tax advisor CPA. Position income, if you are able to take the tip overtime senior deductions, maybe get that tabletop of 20 to agree to a wink 20% tip that you don't put on there, because then that amount is not taxable up to the limit, $25K. Revisit estate documents for the $15 million per person exclusion. Business owners, confirm your W-2s are compliant now. Time equipment purchases under the permanent expensing 179, as well as bonus depreciation. Model QBI against reasonable compensation. Also, my addition there is to bring in your financial advisor and make sure that you have their input on any 401k. adjusts vendor systems to the new 1099 thresholds, restructure for NCTI and FDDEI. Employers complete benefit plan amendments, budget for new immigration fees, prepare communications on health coverage changes, standardize I-9 and worksite compliance protocols. That's it. The key to all of this is being proactive and not waiting until it becomes a disaster to get organized. If you have any questions, reach out to me. You can reach me, our website, email. We have a pretty full practice. We are taking on some new clients, but if we don't have room in the practice, I have a great list of CPA firms that I trust, great financial advisors and CFPs that I trust, as well as attorneys. I really try to keep a good list of people that I can plug in to meet all of your financial planning tax needs. So that's it for now.